The M is Behavior of Markets by Benoit B, Mandelbrot and Richard L, Hudson, Mandelbrot's Heresies. Welcome to yourbooksummary.com. The accepted orthodoxy on finance is a rational and stable body of thought and practice. Mandelbrot's 10 Heresies of Finance challenge this idea. Markets are like roiling seas. Markets are like turbulent seas, with currents, eddies, streams, channels, flows, and backflows all mingling and affecting each other. Some days prices don't move at all, while others leap and plunge. Long-term dependence is also a factor, such as IBM's decision in the early 1980s to use Bill Gates's DOS as the PC's operating system, which has consequences today. Financial theories fall short. Market risk exceeds standard financial theories. The equity premium puzzle perplexes economists due to long-term investment stock returns compared to bonds. Conventional models do not capture the market's long-term dependence and scaling, making it much riskier than assumed, thus resulting in the equity premium as fair compensation for higher risk levels. Market timing makes good, sound sense. Brokers and financial advisors almost always advise against market timing for retail clients. However, Mandelbrot's analysis shows that market moves cluster, and few significant moves cause the most gains and losses. Prices do not move slowly and steadily. One of the main reasons markets are riskier is their discontinuous and large jumps. Market time expands and contracts. Financial orthodoxy assumes the market clock runs at the same speed for everyone. However, prices scale with time. The fractal analysis allows for flexible time. Markets are the same always and everywhere. Fractal geometry provides a mathematical framework for studying patterns that remain consistent regardless of changes in scale or time. While economists often contend that economics lacks invariances and rely on adding or modifying parameters to deal with changes in volatility. Identifying and analyzing these invariances using a multifractal model is likely to be more productive. Bubbles will happen, you can count on it. Financial prices follow a scale, making it equally likely for a stock to experience a big price movement after an initial large one as it is for a moderate movement after a middling one. Therefore, bubbles can occur. Markets deceive. Market pundits identify and interpret patterns in data, but long-term price dependence may cause price changes that are merely products of chance. Technical analysts' reading meaning into them is fatuous. Volatility is easier to predict than prices. According to conventional financial theory, price movements are random and independent of each other, following a normal bell curve. However, big price moves seem to cause other big moves and little moves to cause other little moves, meaning that they are not mutually independent and randomly distributed. As a result, options traders make money by correctly predicting and protecting against volatility, often using unconventional financial models. Efforts are being made to forecast volatility in the same way as meteorologists predict the weather. Value is not worth much in financial markets. Financial analysts attempt to determine the basic economic value of companies, countries, or currencies by examining various factors. Still, the existence of such a value is elusive and difficult to calculate. What is important in markets is the differences in price from place to place or from time to time rather than absolute value. I hope you found the information about the them is Behavior of Markets by Benoit B, Mandelbrot and Richard L, Hudson. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I'll see you in the next video.